In this video, we're going to discuss how to allocate income and losses to shareholders of an S corporation. So remember that an S corporation is a flow-through entity. And what that means is that any income, losses, tax deductions, or tax credits of the S corporation are going to flow through to the shareholders and be taxed at the shareholder level. So if an S corporation earns a profit, the S corporation itself will not be taxed on the profit. Instead, the profit will flow through to the shareholders of the S corporation, and they'll be taxed based on their pro rata share of any separately and non-separately stated items. So you might be wondering, what is a separately stated item? Well, separately stated items are listed on Schedule K1. So each shareholder of the S corporation is going to receive a K1 from the corporation. Okay, Form 1120S, that is the tax return of the S corp itself, but then every shareholder gets a K1. So on the K1, it's going to lay out that shareholder's pro rata share of the different items. Okay, separately stated items include things like a long-term capital gain. Okay, so right here you would report a net long-term capital gain. Or if you had a short-term capital loss, if there were royalties, if there was interest income, if there were qualified dividends. So all those things are going to be separately stated. And the reason that these things are going to be separately stated is that they can affect the tax liability of each shareholder differently, right? Each shareholder has a different tax situation that they happen to be in. So certain items of income, deductions, and so forth are going to be separately stated, and then you're going to have some other income or loss that is non-separately stated, okay? So remember that the shareholder is going to get their pro rata share of both separately and non-separately stated items. So let's say that Jessica owns 20 of the 100 shares of an S corporation. So she owns 20% of the shares. So that's her pro rata share. So she's going to get 20% of any non-separately stated income or loss, any separately stated item. So let's say that the S corporation reports a $300,000 non-separately stated income, okay? But then in addition to that, the S corporation also reports $60,000 of qualified dividends, okay? And $40,000 of long-term capital gain. So now each of these items, Jessica's going to get a 20% share of that. Okay, so the non-separately stated income, she's going to get 20% of that. So she's going to have $60,000 of income, right, that she's going to have to pay tax on. This is going to flow through to Jessica's tax return, right? The S corporation itself is not paying tax on this. Jessica's share of that non-separately stated income is 20% of $300,000 or $60,000. But she's also going to get 20% of the qualified dividends. Okay, so that 20% of that is $12,000. That's not saying, by the way, that she's going to receive a distribution. She's going to be taxed on her share of these items whether or not she receives a distribution from the S corporation. Okay, so she's going to be taxed on 20% of the $60,000 of qualified dividends, and she's going to be taxed on 20% of this long-term capital gain. So 20% of $40,000 is $8,000. Okay, so on Jessica's tax return, she's going to have $60,000 of income from the S corporation related to the non-separately stated income the S corp generated. And then she's going to have $12,000 of qualified dividends and $8,000 long-term capital gain. Okay. Now, what if, hypothetically, let's make it a little more complicated. What if Jessica had sold 5 of her shares partway through the year? So let's say that after 146 days, so 146 days into the year, which I picked that number because it would make the math easy, that's 40% of the way into the year. So 40% of the way into the year, Jessica sells 5 of her shares. So basically, for 40% of the year, she has 20 of the 100 shares. And then for 60% of the year, she has 15 shares out of the 100 shares that the S corp has. So she basically owns 20% of the corporation for 40% of the year, 15% of the corporation for 60% a year. So I've done the math here because when you have someone that sold part of their interest during the year, pro rata is going to be determined on a per share, per day basis. So what I've got here is I say, okay, look, she owned 20% of the shares, and then we multiply that by 146 divided by 365. She owned it for 20% of the shares for 146 days out of the 365 total. Okay, and then she owned 15 out of the 100 shares times 219 days remaining out of the 365 days for the year. So if you do the math here, you'll end up seeing that this is 17%. So then if this had been the case where she sold 5 of her shares 40% of the way through the year, then instead of using 20% when she's calculating her pro rata share, it would be 17%. That would be her new pro rata share, assuming that she had sold 5 of her shares during the year. So now you always use this per share per day basis to determine the pro rata if someone sells their shares during the year, unless that shareholder were to dispose of their entire interest. So if Jessica got rid of all 20 shares 146 days into the year, then basically what the shareholders could do is they could basically elect to say, all right, as of the day that she disposes of her entire interest, they're going to break it into actually 2 tax years. Okay, so you're going to have a short tax year. You're going to have 2 different tax years, with the first tax year ending on the date that Jessica disposed of her entire interest. Okay, now, what if the S corporation had incurred a loss instead of a profit? So I gave an example where clearly the S corp was making money and we were having to allocate out this income to the shareholders. Remember, it's a flow-through entity. It's a flow-through entity, so that means that if the S corp has a loss, that's going to flow through to the shareholders, and the shareholders will be able to deduct that loss, provided they don't run into one of these limitations, okay? Shareholders are going to get allocated their pro rata share of any loss incurred by the S corporation. However, their loss that they're going to be able to deduct is limited to their basis in the S corp stock, plus the basis of any loans that they have personally made to that corporation. Okay, so let's say that we're talking about someone named Tom, and Tom's basis in his S corp stock is $25,000. And he also made a $5,000 loan to the S corp. Okay, so now, and so his basis in the loan, let's say $5,000, his basis in the stock is $25,000. So total that he could deduct in terms of having a loss, if it would be $30,000. So if there was, like, let's say Tom's share of a loss was $75,000, he can't deduct that full $75,000 because his basis plus the loan is only $30,000. So basically his basis in the stock and the loan would go to 0, and then he'd still have $45,000 left there. Okay, so he wouldn't be, you can't deduct more than your basis in the stock plus the basis of any loans that you have personally made to that corporation. Now, other loss limitations apply. There's the passive loss rules under Section 469. There's this at-risk limitations under Section 465. And there's also the excess business loss limitation under Section 461. So those loss limitations apply as well. Now, a couple things to note. Number one, any distributions made to shareholders are accounted for before determining the loss limitation pertaining to basis and so forth. Okay. Next thing I want to note is any losses that are disallowed. Like in this example here, I said there basically be 45,000 of losses that Tom would not be able to take because he didn't have the basis to take those losses. So those disallowed losses can be carried forward to a future tax year until the time that Tom does have enough basis, right? If Tom later does something that ends up increasing his basis, or something happens that increases Tom's basis, and then he can go and take those losses at a later point in time. Now, finally, you should know that Section 1366E of the tax code gives the IRS the power to reallocate the income of an S corporation if a shareholder's family member were to provide services or capital to the S corporation and not receive reasonable compensation. This is just in place to prevent a family from using an S corporation as a tax shelter.